In mid-June, SpaceX priced the largest initial public offering in history, pushing its valuation past $2 trillion. Exactly 4 days later, the company exercised an option to buy Anisphere, the startup behind the AI coding tool Cursor, for $60 billion in an all-stock deal. The pairing is unusual. An aerospace conglomerate known for orbital rockets and global satellite networks is buying a software application that most people outside of software engineering have never used. Comparing the numbers, a towering $60 billion purchase price sits against Cursor's roughly $4 billion in trailing annualized revenue. At 15 times revenue, this is the largest acquisition of a venture-backed startup ever recorded. That headline ratio looks like a textbook tech bubble. But look past the sticker shock to the underlying financial mechanics, and the $60 billion price starts to look like a calculated strategic steal. A 15 times revenue multiple is undeniably steep by traditional software standards. However, Cursor is outperforming those standards, currently maintaining the fastest revenue ramp in the history of business software. Cursor hit $2 billion in February, $3 billion in April, and $4 billion by June, doubling revenue in 4 months. Projections carry this to a $6 billion run rate by late 2026. Running the math against that $6 billion figure collapses the $60 billion price tag to a 10 times multiple, roughly half of what acquirers typically pay for high-growth AI software. Pricing a hyper-growth company like Cursor on past performance is like pricing a rocket based on last year's launches. When evaluated by where the revenue will be in a few months, the valuation represents a discount. There is also the matter of the payment itself. SpaceX spent absolutely zero cash on this deal. Instead, the company paid entirely with its newly minted post-IPO Class A stock. With SpaceX's total valuation approaching $3 trillion, the $60 billion purchase cost the company less than 3% of its total market cap. The market reacted by driving SpaceX stock up 16% on the news, a surge that briefly pushed the company's value past Microsoft and Amazon. Multi-billion-dollar acquisitions become practically free when a company's stock is highly valued and the market rewards them for spending it. Even a free acquisition requires a viable business model. Before the SpaceX deal, Cursor was struggling with a structural flaw in its operations. This flowchart illustrates the margin trap. Cursor was forced to rent intelligence at expensive retail prices from outside labs, while competitors owned their own models and operated on cheaper wholesale economics. As supplier costs created a squeeze, Cursor's market share fell from 41% down to 26%, even as their revenue continued to grow. SpaceX provides an immediate exit from this trap. Cursor now has direct access to xAI's frontier models and the massive Colossus supercomputer banks shown here. By routing operations through this internal infrastructure, SpaceX turns Cursor's single largest expense, third-party API fees, into a low-cost in-house input. It secures over 1 million paying users, creating the structural leverage to turn an unprofitable AI cost center into a business with sustainable, fat margins. This strategy carries significant risks. If the current SpaceX valuation proves to be a bubble, the stock used to buy Cursor will lose value, making the deal look very expensive in hindsight. There is also an operational risk. Fixing the profit margins requires steering users toward in-house models like Grok. If SpaceX throttles access to superior outside models to save money, they risk degrading the product. Software developers are not a captive audience. If Cursor fails to offer the best results, users will move to competitors like Windsurf or Claude Code. Viewed strategically, the acquisition is a software-based execution of vertical integration, the signature move of the Musk empire. Just as SpaceX built its own engines and rockets in-house to bypass external suppliers, it is now applying that same logic to the AI stack. SpaceX used appreciating paper to secure a profitable distribution choke point, a massive developer audience, and a working in-house model team. If SpaceX integrates the technology without breaking the product, $60 billion will be remembered as the price of owning the primary interface where modern software is built.